Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're going to look at what's called sequence of return risk and how to deal with it. And this topic comes from a viewer named Marshall. He wrote in and had the following question. He said, "Hello, I recently discovered you on YouTube and really enjoy your videos. Can you do a video on sequence of return risk? Retired a year ago and need some strategies to help alleviate this risk. Thank you in advance." Well, Marshall, that's a great question. And if you are in retirement or nearing retirement, it is probably one of the most important issues you can think about. So what I'm going to do in this video, we'll talk about what it is very briefly, and then we're going to look at a number of strategies that you can consider using to deal with it. So sequence of return risk, and I would also add sequence of inflation risk, but I'll just use the term sequence of return risk to sort of deal with both of them, is the risk associated with the following scenario. You retire, you're excited, year one, and the market crashes and inflation goes sky high. Kind of sounds familiar, doesn't it? That's the idea, is that how the market performs and whether inflation is high or low is really important in, say, the first 10 or 15 years of your retirement. And here's why. We could imagine two different 30-year retirement periods, and we can assume that both of these two different retirement 30-year periods had the same average market returns and the same average inflation. However, if in one of them the bad years were, say, the first 10 years of retirement, and in the other the bad years were the last 10 years, even if the averages were the same, the retirement that started off with those 10 bad years would fare a lot worse because their portfolios would fall at the same time while their spending and expenses went up, and you could easily deplete your money before the 30 years is up. So the sequence of the returns in retirement and the sequence of inflation are really, really important. And so as retirees, we have to sort of deal with that and understand that those first 10 or 15 years are critical. How do we do that? So I'm going to kind of walk through 5 ways we can think about dealing with, again, I'll call it sequence of return risk, but it's really not just market returns, but inflation, how we deal with that. Now, the first one is, imagine if we said, we know what we're going to do. We're going to go back in time, and we're going to look at 30-year retirement periods. We'll go back 100 years, and we'll find that period of time where the sequence of return risk was the absolute worst. And we'll say, okay, for that really bad scenario, what could I have started with in terms of a withdrawal rate? How much could I have spent in year one of retirement, and then adjusted my spending going forward by the rate of inflation, and still, have been okay, not run out of money? What was the worst possible sequence of return risk period? And what withdrawal rate would have still lasted for 30 years? And so there's no guarantees, that some year in the future won't be worse. But boy, if I can find the worst of the worst over the last century, given that there are no guarantees no matter what approach we take, that's a pretty safe approach. Well, they've already done that, right? That's the 4% rule. That's exactly what Bill Bengen did in his 1994 paper. He went back to 1926. And he started working forward. He said, what was the worst of the worst? And it turns out the worst time to retire was in the late 60s. And actually, let me show you that. We are looking at a free app called ficalc.com. And you can model different withdrawal strategies. We're going to actually look at the constant dollar. And it's called constant dollar because the Bill Bengen approach, you adjusted for inflation every year. We've got $1 million portfolio. We've got an allocation of 65% equities, 35% bonds. You can obviously change this and make different assumptions. And we're going to assume a $40,000 initial withdrawal rate. We are going to adjust it for inflation. You can see that here. And according to this tool, it's got a 95%, 96% chance of success. And this actually shows us what years it failed. Those would be the years in red. Portfolio ran out of money. We're assuming, as you can see up here, a 30-year retirement. And so the results this tool is showing are actually a little different than Bill Bengen, because at 4%, he concluded that there was no failures. And so part of that could be probably from the asset allocation and the assumptions that are being made on how you're investing your money. But in any event, we can see that the late 60s here were the tough years. And the reason I want to point this out is, if we look at the S&P 500 returns, let me get rid of that, and we go to 1965, which is right here, and we start to move forward, 12%, that's a good year, lost 10, up 24, up 11, down 8, up 4, 14, up 19, 2 bad years in the early 70s, but then, these are all pretty good returns. When we look at this, that doesn't seem so bad. The problem came in there were a couple of bad years, 73, 74, but the big problem was inflation. And that's why the late 60s turned out to be the worst time to retire in more than a century. The data has actually been extended all the way back to 1871. And it was inflation of 6% or higher for over a decade. That's what really hurt retirees if they were adjusting their annual spending by the rate of inflation. But that would be one approach. It's basically the 4% rule. And if you wanted to be a little more conservative, you could drop that down to 3.5%. But of course, for a lot of folks, either that's just not feasible, or they'd frankly prefer not to go that route. So what are the other alternatives beyond the 4% rule? Well, the second one would be, don't adjust for inflation. Just pick a withdrawal rate, and every year take out that same percentage, whatever that might be. And so the good thing about that is you can start at a higher rate. In fact, we can look at that in the FI Calc model. I've got the same setup, $1 million, same portfolio, starting with 40,000, but I've removed this tick mark, so I'm no longer adjusting for inflation. And you can see the success rate jumps to 100%. There's no red, no orange, which would show you that the final portfolio was below 35%. Everything looks fine, and we can now come over here and we can start to increase this. What happens if we go to $45,000? Okay, we still haven't run out of money. What if we go to 50,000? That'd be 5%. All right, so we've had 1 year, 1929. We know what happened in that year. And of course, there's no guarantees that the future will be like the past, but we can start looking at different withdrawal rates. The key sort of takeaway is, if you don't adjust for inflation and you just use a set percent, you can start off with a higher initial withdrawal rate. That's the good news. The bad news is your yearly spending is going to be very volatile. Imagine you started $1 million and you're going to use, say, 5%, so you take out 50,000. That leaves you with 950, and then the market drops by 20%. Okay, well, now in year 2, you're going to stick with the same 5%, but your spending is going to go down. And so that's the problem with this second approach is your spending from year to year fluctuates wildly. So that gets us to the third approach, and it's a dynamic spending rule where your spending can change, even factoring in inflation. And I'm going to give you actually 3 ways to think about dynamic spending. The first is what's called the Yale spending rule. It's named after the Yale endowment because it's roughly how Yale goes about figuring out how much it can spend each year from its multi-billion-dollar endowment. And what it actually does is it takes a combination of the first 2 approaches we just discussed, the 4% rule and the percentage of portfolio rule. And here's roughly how it works. There are different ways to implement it, but one would say, okay, we're going to follow the 4% rule. We're going to take out, whatever we took out last year, we're going to adjust that for inflation, just like we would with the 4% rule. But then whatever that number is, we're going to only take 70% of it. And so that's part of our spending for the current year. What about the other 30%? Well, we're going to take whatever our portfolio balance is, right, and multiply it by, let's say 5%, and take 30% of that. So effectively, we're going to get 70% of our spending from the 4% rule and 30% of our portfolio from the percentage of portfolio approach. And that's the Yale spending rule. They sort of do a little bit of both. So you get some inflation adjustments, but you also have a spending amount that does reflect whether your portfolio has gone up or down that year. So that's one approach, and you could do more research on the Yale spending rule to get a sense of that. And by the way, this particular tool does model the Yale spending rule, and it's called the endowment strategy. And so you could look at that here, and if you click this button here, you'll get a description of it. And in fact, this formula, which looks intimidating, but trust me, it's not, is basically what I just described. All right, that's the first dynamic spending rule. The second one would be just basic guardrails, where maybe you start at 5%, but each year, and you adjust for inflation, but each year before you actually take the money out and spend it, you take whatever the amount is, you divide it by your total portfolio, and if the result is greater than 6%, you ratchet down your spending to no more than 6% of your portfolio. And you might ask, well, what would cause it to be greater than 6%? Well, if there was a bad market and your portfolio dropped, that could do it. And of course, if there's high inflation, so that your inflation adjustment really increased your spending for the year, that could do it too. And certainly a combination of those two things could certainly have you spending more than 6%. And so the guardrail kind of keeps you on the road, right? When you get to that 6%, you cut back. And you could also have a guardrail on the low side, so that if the result of taking your spending for the year, dividing by your portfolio, was less than 4%, you could, if you wanted to increase your spending to that 4%. So that's another sort of dynamic spending rule. And the third one I'll give you, the idea is risk-based guardrails. And the way to think about that would be Monte Carlo analysis, which is where you model, say, 1,000 different scenarios of different returns and inflation, and then you look at the success rate of your plan. In other words, how many of those scenarios did you have enough money, and how many of those scenarios did you run out? And there are tools that can help you do that. One that I use is New Retirement, but the idea of risk-based guardrails might be if you'll shoot for an initial withdrawal rate that gives you a 90% chance of success. And then you reanalyze your portfolio and your plan every year. And if because maybe the market's up and inflation is low, one year you have a 99% rate of chance of success, you could increase your spending. On the flip side, let's say the market's been down and there's high inflation, and so you put the numbers in and your chance of success drops to 70%, then you would reduce your spending. And there's an article that I'll link to below the video, and it is this one. It's from the Kitz's website, great website. He didn't write this article, and it's a long one, as you can see, but it's written by these two gentlemen. And here it is, the retirement distribution hatchet, using risk-based guardrails to project sustainable cash flows. One thing I'll say about dynamic spending is that, again, there are pros and cons to every approach. There's no one right approach. One thing, though, that I would say about all of these sort of approaches to sequence of return risk to keep in mind is that studies have shown that retirees spend less as they age. Their medical expenses might go up, but their overall spending goes down. You're going to spend less in your 80s and 90s than you likely did in your 60s or 70s. And a lot of times these dynamic spending rules can actually reflect that change as you age. All right, two more approaches that I want to talk to you about real quickly. The first one is we can reduce our volatility. Remember, sequence of returns risk, the real risk is in that first 10 or 15 years. And so folks have come up with different ways to reduce volatility during those years. One would simply be to annuitize part of your portfolio. You could buy an immediate income annuity, and it might not solve all of your income needs, but it could solve many of them and reduce the need for you to rely on what's left in your portfolio. Again, there are a lot of pros and cons. The two things I don't like about annuities today, one is they do not adjust for inflation, and two, and there are exceptions in different ways you can approach an annuity, but generally, once you've bought the annuity, the money is no longer yours to control. And if you pass away, there's nothing for your loved ones to inherit. Generally, there are some types of annuities where you can buy some provisions effectively that might alleviate some of these issues, at least in the early years of the annuity. But that's one approach, is an income annuity. And then the second approach is called the rising equity glide path. All that is just a fancy term for what's your stock bond allocation. And normally we think that as we age, stocks go down, bonds go up. Well, with the idea with the rising equity glide path is that early in retirement, you actually have more fixed income, more bonds, and fewer stocks. Let's say, just as a hypothetical, 65% bonds, 35% stocks. And as you age, you actually increase your equity and decrease your bond allocation. And there are different ways to do it, just from rebalancing and gradually changing the allocation from year to year. You could spend down your fixed income in the early years, and that would cause the allocation to change. So there are different ways to do it. But the idea is, if the first 10 years are really volatile, particularly in the stock market, and you have bad years, a rising equity glide path could help. Now, of course, one big potential downside to a rising equity glide path is if your first 10 years of retirement, stocks are really up and do really well. So again, there's always trade-offs. I will link to an article. Again, this is from Kitces as well, along with Wade Pfau. They've done research on this. But this is the article on the benefits of the rising equity glide path. I have to say, I am not, I understand the math and the logic behind it. Probably not an approach I would take, but I think it's worth considering. And they actually link in this article to a study that they both did on this. Now, the final approach to dealing with sequence of returns risk that a lot of people are comfortable with is the bucket strategy. And the idea is you have a cash bucket of 2 or 3 years of expenses, sort of a second bucket of maybe 5 years of fixed income, and then a third bucket maybe with stocks and riskier assets. The theory behind it is if the market crashes, then you could just for a couple of years live on your cash. And I'm not a huge fan of the bucket strategy because you have to end up with these decision rules as to when you move from one bucket to another. The second thing to keep in mind is it doesn't help you with inflation, right? If inflation is high, you still have to figure out how much you're going to take each year and are you going to adjust for inflation or not. One of the things Michael Kitces says about the bucket strategy is in many ways, it turns out to just be a rising equity glide path approach because people in bad years are simply spending the fixed income down, leaving their equities alone, and so their equity allocation ends up going up. Maybe not a bad thing, but at the end of the day, I personally think just rebalancing a portfolio every year is an easier and frankly more effective way. However, I do know that the bucket strategy can give retirees a lot of comfort. One approach to it, I'll call it a modified bucket strategy, is to simply have your basic asset allocation, whatever it is, say 65% stocks, 35% fixed income, or whatever your allocation is, but have part of that fixed income piece in cash, maybe 2 to 3 years worth of expenses, but it's part of your bond allocation. And that might give some folks some comfort. Again, you still have to figure out how often do you replenish that cash as you're spending it down. It doesn't solve all of the problems, but it might give some folks some comfort. I know I've run through these, what are, I think, admittedly pretty complicated approaches and approaches that, really you need to give a lot of serious thought to as you figure out your own strategy. The one final thing I'll say is I really do recommend, I use New Retirement. It's not the only tool out there. On Trajectory is another, and I'm actually examining additional tools. But these are retirement planning tools that allow me to sort of on a regular basis, evaluate where I stand in terms of retirement readiness. And I recommend that you use some kind of tool to keep sort of track of where you are, regardless of the approach that you take to deal with sequence of return and inflation risk. I'll leave, as I said below this video, links to the articles that I showed you, as well as the FI Calc app, which I think is handy. And so hopefully those will be useful to you. If you have any questions, leave them in the comments below. I'll do my best to help you out. And until next time, remember, the best thing money can buy is financial freedom.